Welcome to the 2024 market forecast presentation. My name is Kyle Berg, and I am a partner and financial planner at Affiance Financial. With me today is Marc Usem, a partner, chief investment officer, and chair of our investment committee.
Hey, Kyle, good to see you tonight. Great to be here.
Always good seeing you, Marc. But before we begin, there is a couple housekeeping items to make you aware of. We will be utilizing Slido a couple times for audience participation. If you would like to scan the QR code that is on the screen with your phone, you can go to slido.com using the hashtag Affiance. Once you have it pulled up, you'll be able to be logged in and the questions will come onto your screen automatically. Closed captioning has also been enabled for this presentation, but you can disable it if you would like. The slides we are going through today are available for download below if you would like to also follow along. Additionally, this meeting is being recorded and will be made available. One final piece is some required disclosures that I will read to you. Please remember there can be no assurance that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and/or applicable laws, the content is only reflective of current opinions or positions and is subject to change at any time without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as a receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to be available upon request. And with that, take it away, Marc.
Thanks, Kyle. Thanks for the introduction. Tonight's presentation is entitled Artificial Intelligence Takes Center Stage, and we will talk more about that in a few minutes. Before we get into it, though, we always like to start with a predictions disclaimer. I love this quote by Daniel Kahneman. The idea that the future is unpredictable is undermined every day by the ease with which the past is explained. Sort of a long way of saying it's great to be a Monday morning quarterback. So I'm going to introduce our team. Before I do that, I just want to thank our marketing team, Marcia Zappa and Keely Mattis, for helping to put our presentation together and put this whole program together. Thank you very much. So Kyle, thanks, you introduced me. I'd like to also introduce two of my associates, Tanner Steele and Ryan Smith, who work closely with me on investments, and they run the trading department. In addition, our investment committee includes our team, our founding partner, Steve Lear, and our founding partner, Andy Fishman, one of our other partners and advisor, Dan Lear, a partner, our president, and chief compliance officer, Eric Unger. We meet every month as an investment committee to review the current status of the investments in the markets. We spend a lot of time and resources on this process and take it very seriously. So let's talk about our agenda for tonight. We're going to take a look back at 2023. We're going to look at where we are now in 2024 and what we expect later this year. First, let's take a step back and look at 2022. 2022 was a terrible year. The blue line on the top shows bond market returns. The orange line on the bottom shows stock market returns. We can see last year, bonds were down 13%, double digits, the worst in history and the first time that's ever happened. Stocks were down 18%, clearly a bad year, not the worst ever, but the worst for combined stock and bond portfolios in history as well. Certainly don't want to repeat that. It was the worst year for stocks individually since 2008. So we're going to jump right into an audience question. After that terrible year in 2022, how did you feel about 2023 going into this year?
Again, we're utilizing Slido. You can go to slido.com, put in the hashtag Affiance, or scan the QR code. Can't wait to see what people thought. It really is amazing the breadth of what happened in 2022. Not only were stocks and bonds down, but there was also inflation, which was up. There really was nowhere to hide, Marc.
I mean, the only place to hide sort of was cash.
Yeah, I mean, it looks like people were pretty pessimistic.
That kind of makes sense. We all have this recency bias. We always think that what was happening is going to continue happening, and that always colors judgment. Really interesting.
I always appreciate people's honesties. I know when we were talking, getting ready for this, it's like, I wonder how many people are going to say, oh, it was going to be a great year.
All right. Well, the consensus is pretty clear, right?
It looks like it. Up 0 to 5% was the expectation.
And then, or another down year, right? I mean, not terribly optimistic. Well, let's jump into what happened. Experts missed the mark. So nobody should feel bad about saying it wasn't going to be a very good or maybe another down year because clearly the consensus. So Wells Fargo said recession in the first half of 2023 from Fed rate hikes. America said expect GDP of about 0.1 or 0. Stocks up 10%. That was pretty bullish. Goldman Sachs said US will narrowly avoid a recession in 2023 with GDP growth of just 1%. Bloomberg says 100% probability of recession. Economist says a global recession is inevitable in 2023. And JP Morgan says stocks up 9%, another more bullish estimate here. And then T. Rowe Price says underweight stocks. Clearly, they were all wrong because 2023 was an unexpectedly good year. Let's go through what happened in 2023. U.S. stocks, S&P 500 index up 26%. Growth index up 42, almost 43. Value up 11. Huge disparity between growth and value again last year. Still both positive. And then NASDAQ 100, mostly largest tech companies, up 54% last year. Just tremendous. Global stocks were up, although not as much as the U.S. Global stocks up 22%. That's all world together, U.S. international and emerging. International by itself up about 18. Emerging markets, the laggard, largely due to weakness in China, up only 9%. So again, everything's still positive, just up less than the U.S. The bond market ended up being positive for the year too. The U.S. aggregate bond index up 5.7. Cash up 5%. Great year for cash. High yield bonds up 11.5. So across the board, bonds did well last year. Commodities were the soft spot. Oil flat. They call them softs, which is corn and soybeans. Agricultural products down 29% and 10% respectively. And then gold up about 14%. So really, except for those agricultural products, everything had a pretty good year, a really good year. So let's go into 2023 in a little more detail. So last year, the year started out pretty strong, January, February. And then the Fed came out and said, rates are going to be higher for longer. And markets sold off on that. Right around end of March, Silicon Valley Bank failed. The Fed had to step in, put a new credit facility in place, which did quickly stabilize markets and set the stage for the next up leg. Markets then advanced through the summer with the release of ChatGPT-4 in March. And that really set the stage again for this tremendous tech rally that took place during most of the summer. During this time, bonds kind of treaded water because interest rates were actually rising throughout the year. The 10-year Treasury rate went up almost 1% during the year, hit almost 5% in the fall. As Treasury rates rose, you can see bond prices declined. And by October, we're actually down for the year. We saw a 10% correction in stocks that fell to only up 8.7. And then as we enter the fourth quarter of the year, the Fed comes out and says, you know what? We might be cutting rates next year. Now, they don't always say it as clearly as that, but that was the hint at least. Markets took that to heart and rallied strongly in the fourth quarter with both stocks and bonds rallying. I think it's important to look back on that 10% correction because I think a lot of people were nervous during that time period. And, 10% corrections are uncomfortable, but they're pretty common. So here's last year, 2023, markets up 24%. We certainly had that 10% correction. But if you look back through time, 10% corrections during up years are not all that unusual. They happen on average, actually, once a year. Not exactly once a year, but pretty much once a year. So it's something that we should be comfortable with as part of the investment process. Another interesting thing about last year is how concentrated markets were. The blue line on top is the S&P 500. It's a cap-weighted index, meaning the largest stocks have the most influence in the index. And the orange line below is the equal-weighted S&P 500, where every stock is given an equal weight, 1/500th. And you can see the cap-weighted index was up almost twice what the equal-weighted index was, meaning the largest stocks drove the index. How extreme was it? Really extreme, actually. The top 10 stocks were responsible for 75% of the index return last year. That's a record. Going back to 2014, we can see nothing even close to that. And we know some of these top names because they were in the news so much last year. NVIDIA up 239%, Meta 194, that's Facebook, right? Broadcom up 100, Tesla 100, Amazon 80, Eli 60, Alphabet 58, Apple at the very end up only 49%. Just a tremendous year for large cap tech companies in general. So let's put this a little bit in more context here in terms of index concentration. Looking at last year, this is just weight in the index, not performance, just weight in the index. Top 10 stocks were 32% of the index. During the dot-com bubble in 2000, it was 25% of the index, still very heavy at that time. And the average over the past 35 years is 20%. So you can see we're way out here in terms of a record concentration. What does that mean? Well, one of the things it means is there is more concentration risk in the index today. Meaning if something were to happen to one of the largest stocks, it would have an outsized impact on the index. But let's take a step back and look at valuation as well, or the price earnings ratio. That's the S&P price today over the trailing 12 months earnings. And we can see today it's at about 23. At the dot-com or tech bubble, it was 46, so twice today's valuation. And the average over the past 35 years, 24%. So even though markets had a great year last year, they came off a terrible 2022, and valuations are pretty close to average. If we take it another step and say, okay, well, we saw what the overall valuations is, how about those tech stocks? Well, if you just take the top 7 magnificent 7 tech stocks, and you look at their historical price earnings ratio, you can see again that it's nowhere near extremes. It's actually low relative to recent history. Now, it's interesting because while they did drive the index, look at the earnings growth expected for those top 7 stocks, almost 40%. Whereas the rest of the S&P 500 earnings for 2023 was only down to about 2%. So there's a reason these stocks are driving things. They're really doing well. So what are the takeaways from 2023? I think one is you can't time the market. The key is time in the market, not market timing. You could see the volatility last year, the 10% correction, not uncommon, right? That's something that we know we have to live with as investors. You got to be in it to win it. And I think we've entered a new technological era of artificial intelligence. That clearly is what's been driving the largest tech stocks this year.
Mark, at the start of the presentation, you showed an empty stage talking about AI taking center stage, which clearly drove the markets. And one of the biggest players in AI in 2023 was ChatGPT. With that, our Slido question is, how long did it take ChatGPT to reach 100 million users?
Yeah, that's a lot of users. I like to look at the historical sort of record of technology adoption, going back all the way to microwaves and fax machines, and then PCs and cell phones, and all of these things have adoption rate curves that continue to increase at the speed or the rate at which these things are adopted. And as we enter the technological or online age, I think these things get adopted even faster.
Yeah, I mean, I attempt to be an early adopter when it comes to technology, and I downloaded ChatGPT right when it came out.
Well, what did you do with it?
Well, I used it, found a useful use for it by coming up with bedtime stories for my kids.
Oh, so personal use. That's pretty cool.
Yeah. I mean, it looks like people are saying it took about 2 months to reach 100 million users. Just to give some scope around 100 million people, that's about 1/3 of the country's population.
Well, we got a smart audience, don't we? Let's jump into the answer. So it took ChatGPT just 2 months to reach 100 million users. I mean, that's just really astounding. I like looking back at Netflix, which many of us are familiar with, but they started in the 90s shipping DVDs to people. So I'm not sure that's a fair comparison. You had some physical goods as well as electronic, but look at Spotify, 11 years, going up the list. Facebook, Meta, 4.5 years. Most recently, TikTok at 9 months. I mean, 2 months to reach 100 million users is really astounding. So let's kind of look at some of the major market trends and how does this fit with that? And I think it does. Going back to the 60s and 70s, the top 50 stocks in the S&P were known as the Nifty 50. And this was a consumer-driven group of names. Many of these are household names that are still in markets and doing well today. McDonald's, IBM, some are gone. Digital equipment, Texas Instruments exists, but Coca-Cola is still here. Kodak, Polaroid, not so much. And Disney obviously is still with us today. But at that time, they were more expensive than the index in general, about twice as expensive. And there was a reason. They were doing extremely well. In the 1980s, we had a PC revolution. The change from mainframes to PCs. And the leaders at this time were names like Atari, Commodore, Osborne, Kaypro, Apple, Compaq, Dell, and Gateway. Most of these names didn't make it, right? Of course, some that Apple for sure is still here and Dell's around in some form, but the others didn't. 2000, we had the dot-com boom, and some of these names, again, you may remember: AOL, CompuServe, GeoCities, Netscape, Excite, all gone. Amazon still with us today, and Yahoo actually was the most valuable company in the world in 2000. Hard to believe. Most valuable company in the world in 2000 is a shadow of its former self. More recently, we had the FANG stocks, or the FANG stocks: Facebook, Amazon, Apple, Netflix, and Google, that dominated in the 2010s. And interestingly, they were all sort of in different segments of the tech market, right? Facebook in social media, Amazon in retail, Apple in smartphones, Netflix in streaming, and Google in advertising. So they all became, really leaders in different segments of the tech market. And now I think we're in this new AI technology era. And I do think it will be transformational. It will change the way we do things and interact with both machines and each other in the future. It's going to have rewards, increased productivity, potentially margin expansion for businesses, and improved lifestyle for many of us. We have our digital assistants helping out. Of course, there will be risks, right? We know there will be job losses associated with this. Nefarious activity like deepfake we've heard about. Maybe machine consciousness at some point down the road. Unintended consequences that we can't even come up with today. And of course, regulation. This is an area where I do expect some more oversight and regulation to at least attempt to be put into place because of the risks. What are the catalysts? Well, scale for sure at this point, and money, as well as computing power and intellectual property. These catalysts really suit themselves well for our investment thesis, which is the largest tech companies today are clearly the early beneficiaries. We think the future AI winners may not yet exist. We might not even know who they are today, but I expect new companies to come into this space and do extremely well. AI may actually transform itself, right? I mean, it's got this intelligence component, and we may use it to actually transform itself and potentially increase the future breadth of this opportunity.
AI was a huge change this last year and will be continued to be a story. But outside of that, what are the other economic impacts that we're facing in 2024?
Well, we're going to shift gears for a minute and focus on these economic topics. So the 5 topics we're going to focus on are the Fed, interest rates and inflation, the economy and GDP, government issues, geopolitical issues, and then we'll close up with valuation and expectations. So first, let's look at the Fed funds rate and the consumer price index. This is probably my favorite slide of all of them. But what you see is the Fed funds rate, which is the red line on top, and consumer price index, which is the blue line underneath. And historically, back in the 70s and 80s, the Federal Reserve would raise the federal funds rate pretty much in line with inflation, or CPI. And this took place throughout much of history. Now, most recently, in the last several years, inflation spiked, largely as a result of COVID and the supply side disruptions that took place. Now, we know early on in 2021 in particular, and part of 2022, there was a lot of talk that this inflation was going to be transitory and sort of resolve itself as the supply chains work themselves out. And the Fed was said to be behind the curve. And it's really interesting because you can see in history, they haven't really been behind the curve, but they certainly are behind the curve in this case. If it was history and they followed inflation, the Fed funds rate could have been 9 or 10%, but it's right now 5.25. Remember, the Fed only impacts the demand side. They can't really do anything to the supply side. So were they behind the curve on inflation? We'll see. Let's look a little more closely at the consumer price index components. So these are all the different components that make up that consumer price index. And we can see that last year and this year, it's really similar in terms of the things that were driving inflation. But this year, or sorry, 2023 was just less so. The orange lines are 2022, the blue lines 2023. Housing being one of the biggest for 2023 as mortgage rates spiked, housing inventory shrunk significantly and prices really stayed buoyant. I think that was a surprise to a lot of people as well. I think the big outlier certainly is oil and fuel oils, which spiked in 2022 due in part to the Ukraine war with Russia, and those went the other way in the past year as much more capacity came online to offset some of that. So interesting to see kind of the same categories, just less inflation over the last year. So how does the Fed fight inflation? Well, we talked a little bit about Fed funds rate. They use the Fed funds rate to increase the cost of money. That's what they're doing when they increase interest rates. The interest rate increase to 5.25%, this dark red line, was the fastest Fed tightening and the most aggressive in history, right? So they might have been behind the curve, but they moved really quickly when they moved. The other tool the Fed has to combat inflation is their balance sheet. When they add bonds to the balance sheet, it's called quantitative easing. When they take bonds off their balance sheet, it's called quantitative tightening, essentially adding liquidity or taking liquidity away from the fixed income markets. In 2008, in the global financial crisis, the Fed added almost over $1 trillion to their balance sheet, which was astounding at that time. We'd never seen anything like that. It was almost an experiment, which tended to work, but yet they continued to add to their balance sheet through the early teens and started to normalize it just before COVID hit. So COVID hits, kind of derails their plans, and now they have to add $5 trillion to their balance sheet to help prevent a depression. Because, right, in COVID, the world just shut down. We didn't know what was going to happen, and they weren't going to let the financial markets slip just based on not having liquidity. So they are now trying to normalize the balance sheet again, which we can see. And this little blip here was actually last year when Silicon Valley Bank failed, and they added a little liquidity at that point. But they are trying to normalize this balance sheet, and that does keep a little bit of pressure on the bond market and yields.
You know, inflation dropping from the 9% highs back to 3.3% by the end of 2023. I mean, we knew inflation would come down, but didn't think it would come down that fast. I got a two-part question for you, Mark. Do you think the Fed is done raising rates? And with that, do you think that we will see more rate cuts this year?
Yeah, good questions. I think a lot of people have these questions on their minds, and that's been one of the drivers of stocks, actually, I think, early this part of the year, is that the expectation is the Fed will be cutting rates. The bigger question is when, and I do think they're done raising. I don't think they have to raise rates anymore. I think inflation is moderating. We expect it to continue to moderate. And so the bigger question is timing. When do you think they'll cut, and by how much? Now, the Fed said they're going to cut. They've already come out. They have their dot plots, their projections, and they've got 3 cuts built into their projections for this year already, although not till later in the year. So with that, let's jump to economy and GDP. So let's look back on last couple of years. 2021, coming out of COVID, things were really, really strong. Going into 2022, we had 2 down quarters starting the year. Now, usually 2 down quarters means that we're in a recession, although the National Bureau of Economic Research came out and said, no, this isn't a recession because we look at other things in addition to just GDP, like employment markets, overall economic strength. And they said this series wasn't enough to actually be a recession. We could argue, but nonetheless, that's what it was. Then pretty strong coming off of 2022. A lot of concerns in late 2022 that this wouldn't continue, but certainly 2023 really surprised everybody. First 2 quarters, solid growth in the 2% range. Third quarter, blowout numbers, almost 5%. And for the fourth quarter, the expectation was high ones to low twos. We printed a 3.3% GDP in the fourth quarter of last year. Really, really tremendous growth, far more than anybody expected. So what are one of the drivers of this? Employment markets. So while hiring may have cooled a little bit this year, we're still running about a 3.7% unemployment rate, which is low by historical standards. If we look back in history, we see employment markets ebb and flow, tending to increase during times of recession. And clearly, COVID is an outlier, with unemployment jumping to 14, almost 15%. Never happened before in history. So strong jobs markets is powering consumers. Another take on the jobs market is we still have an unemployment gap. So there's 8.8 million job openings for 6.2 million unemployed. Now, this gap is really interesting because it's unusual. You don't usually see this a little bit before COVID here, but going back in history, not really a thing, right? So we are still closing this gap, and that is one of the things that has kept employment strong. When employment is strong, it really gives the Fed, I think, a platform to have a lot of flexibility in terms of what they're doing, because full employment is one of their legs of their stool. It's full employment and stable rates, and that's what they're doing. So this employment picture is really strong and helps the Fed a lot. Shifting to economic indicators, we have different timing of indicators, meaning some measure really short periods of time and some longer periods. This first one, the Lewis Merton stock, is a short-term indicator, daily and weekly numbers. We can see trailing down into this year, early part of 2023, a lot of people thought this was going to continue and just fall off here. Did not do that, right? It bounced and actually increased. So short-term economic indicators are pretty strong. Looks pretty good. If we look at Purchasing Managers Index, though, this is more mixed. So manufacturing is the orange line at the bottom, is at 47 or so. Anything below 50 means contraction. Above 50 means expansion. So manufacturing, a little weaker right now in contraction, although not severe. And services, still positive, although not very positive, but around that 50% mark and bouncing around there. So services look okay, and a little bit of weakness in manufacturing. We look at leading economic indicators. This is really interesting because this has correlated highly with past recessions, right? The leading economic indicators going back to the 80s, 90s, 2000s have always been correlated highly with recession. Now look where we are now, under this 5% line, which again, you would expect there to be recession here. Is there a recession today? I don't think there's a recession today. Now, maybe this is lagging more than usual. We'll see. Another indicator for recession or weakness is the yield curve. And this is the difference between 2-year rates and 10-year rates. And what we see when it's inverted, the 2-year rate's higher than the 10-year rate. When that happens, the yield curve, they say it's inverted because normally long rates are higher than short rates. And it's usually because the Fed has raised interest rates for a reason. Now, in the past, this has always predicated a recession as well, although with long lags of 12 to 18 months. So when we look back and we see periods of an inverted yield curve, generally after that, there is a recession. Now, we're clearly here in a very inverted yield curve situation. This does not mean anything is imminent, but it's cause for some caution.
So, Mark, the economy looks strong. The employment numbers are really impressive. but we still see mixed data here. How do you interpret that?
Well, again, I think it's kind of looking at windows of time, right? So in the near term, things look pretty good. The short-term indicators are good. GDP looks strong. Employment market looks strong. Overall, things look pretty good. Now, there are some indicators, our leading economic indicators and yield curve and things like that, that say, there could be some slowness ahead, maybe 12 to 18 months from now, but at least right now, things look pretty good. So let's switch to government. I think the key issue, one of the key issues, at least in government, is the upcoming election this year. And this is a chart of election years going back to 1932. We can see the light blue line at the bottom shows the election years, the darker line, non-election years. And in election years, the early part of the year tends to be pretty choppy, right? Markets kind of don't go anywhere or even sell off a little bit on average. As we move further into the summer and then closer to election day, certainty increases. We know who our candidates are. And finally, at election day, we know who wins the election. Now, whether we like the candidate or don't like the candidate doesn't really matter that much to the markets. The markets care about certainty, and they like certainty much more than uncertainty. And so once this happens, markets tend to do really well. So let's talk about who wins. Is it a Democrat in office or is it a Republican in office? Again, if we go back in history to 1933, we can see that regardless of whether it's a Democrat or Republican in office, markets tend to do pretty good. Now, we care personally about who may be in office, but again, markets kind of don't care and tend to go up regardless of who's sitting in the White House.
I love that last chart you showed, just showing how the market performance during each presidency, and regardless of who's president, the market tends to forge on. But given all the uncertainty around the upcoming election, do you think it could be different this time?
Yeah, I think, there's certainly unique features of the upcoming election. I think the biggest issue, at least in my mind, in the near term here, are the two cases pending at the Supreme Court, right? So we have the question of presidential immunity, as well as a 14th Amendment question that the Supreme Court will answer, which will definitely impact the election one way or the other. Now, again, whether one candidate wins or the other, market may not care, but personally, it will definitely impact how we see what candidates are going to be available for election in November. So important cases. Last time something like this happened actually was Bush and Gore in 2000, when the Supreme Court said, yeah, we're not going to recount the Florida votes. So definitely can have an impact on the election. Again, markets may or may not care. Going into geopolitical, let's take a look at those risks. Because risks abound in the geopolitical space, there are always reasons to sell, right? So what are some of the ones that are facing us today? Ukraine and Russia, clearly a geopolitical risk. How is the G7 going to respond to this? Are they going to continue to support it or not? The Israel-Hamas war, clearly something that's in news today and affecting many of us. The Taiwan-China conflict, elections in Taiwan just took place, and that's created more concern with China, and they've been showing some military presence around Taiwan. And then North and South Korea, where North Korea recently came out before their charter had said their goal is to become united with South Korea. Now they said, no, we're never going to be united with South Korea. We're just enemies. So these things definitely weigh on, I think, again, how we feel about things going on in the world. But we look back in history, bad things happen with some regularity, going all the way back to Kuwait invasion, the first Gulf War. And there can certainly be short-term disruptions in markets, but generally markets just march forward again. They don't care so much, and they just move forward. Going all the other bad things that could happen, whether it's the Gulf War, global financial crisis obviously had a big impact, but in terms of geopolitical, Russia invasion of Kuwait, of Ukraine, this was way back in Crimea, Hong Kong riots, the Brexit vote. So we can go all the way back and see some of the things that have happened that have potentially influenced markets. Now, if you said, look, everything's going to scare me and I'm going to take my money out, you would have probably taken out money at the bottom, where if you just left your money invested, you would have earned an 8% compounded return in this all-cap world index by just staying the course. That doesn't mean, again, things don't get disrupted in the near term. I think the most significant near-term disruption is shipping in the Red Sea. We know cargo volumes are down 50% in the Red Sea, and that's definitely potentially going to affect inflation in Europe and in Asia.
Well, clearly wars are a humanitarian disaster. Do you think there's a risk of contagion with the war in the Middle East expanding with Iran?
Yeah, I mean, I think that's a big question, and that changes every day, as we know. I think, really the US doesn't want a direct confrontation with Iran, and Iran doesn't want a direct confrontation with the US. So I think there could be some maybe regional escalation. I don't see it becoming an all-out war with Iran. At least I hope it's not. But if I had to bet on it, I would say they don't expand it into a broader war. So with that, let's look at some more valuation and expectations. So looking at the S&P 500 PE ratio going back to 1998, this is the S&P 500 price divided by the trailing 12 months earnings. And again, we can see we're at 23, but this is a good picture looking back to the mid 80s of where we sit today. And it's certainly, not the bottom, but it's certainly not at the top either, more close to the average over this time period. If we take a longer term view and we look at something called the CAPE ratio, this is the cyclically adjusted PE ratio. This goes all the way back to 1934. And this is computed by taking the S&P 500 price and dividing it by the 10-year average inflation adjusted earnings. So this is sort of a real, if you will, and longer term indicator. And right now we're about 32. So relative to history, now we're in a higher level, right? Why do we care? Well, we can look back at history and we can say, well, when the CAPE ratio is low, and this blue line here is the CAPE ratio, we're sitting up here today, and this orange line is subsequent 10-year S&P 500 returns. So when CAPE ratios are low, the next 10 years tend to be high. Again, when the CAPE ratios are higher, the next 10 years tend to be lower. This is, again, averages and long periods of time, but nonetheless, the basic relationship holds true. So we're sitting here today at about 31, 32 at the high side of historical CAPE ratios. So in general, we would say next 10 years, maybe returns are a little bit lower than the past 10 years. Of course, a lot can happen, and in any section of that 10-year period, things can change. If we focus just on the earnings side now of the PE ratio, what did the S&P 500 earn over the past several years? Going back to 2016, you can see the trend, except for COVID here in the middle, has been pretty much upward. And next year, the expectation for 2024, this year, 2024, is $250 per share. Last year's was $225 for 2023. So the 1 year expected earnings growth as of today is about 11%. So if nothing else changed, if the PE ratio didn't change, if interest rates stayed fairly stable, you would expect just through earnings growth that the S&P would grow about 10, 11% next year. Let's look a little bit more closely at bonds now. The orange line on top is the 10-year Treasury yield, and the blue line below is the real 10-year Treasury yield adjusted for inflation, okay? So that's your real purchasing power. We are starting at attractive yields, about 4% on the Treasury and about 1.8% real. You have to go all the way back to 2009 to get yields that are this high. So really attractive starting yields. And let's talk about where we think interest rates are going here, right? Because the likelihood is that the Fed cuts rates sometime over this year. So we don't really expect rates to move a lot higher. So the potential is that there's some tailwind from capital appreciation as rates potentially fall as well. So bonds are pretty attractive.
Yeah, I mean, bonds seem very attractive, but the stock picture seems really mixed. Seems like there's a lot of economic data out there, which is also mixed. But what do you make of all that?
I know that's are always a little bit mixed, right? We never have perfect visibility, or everything doesn't always align perfectly. But I think, again, you have to look at time windows, and it's important to, bifurcate where we are today and maybe where we are in the future. So right now, valuations look pretty good. Earnings look pretty good. I would say that overall, stock market's well positioned today based on those things. We saw the CAPE ratios elevated, so looking over a longer, maybe 10-year horizon, maybe it's a little lower, but at least in the near term, things look pretty good. Again, bonds look attractive. High starting yields, high real yields, and the expectation that rates probably don't go much higher and maybe even lower. So again, the picture for bonds and stocks is pretty positive today. So what's our outlook for stocks? Well, we just kind of said it, but let's say it again. Soft landing is possible, I think, this year. The Fed didn't take that interest rate to 10% and then drop it quickly as things really degraded. It only went to 5.25. That, missing the curve for them may actually have been a really good thing. We'll see. But I think that soft landing is possible. I think economic strength is still there. Current PE valuations are reasonable. We're at the early stage of this AI era. So we think there's still a lot to come in this space as this sort of AI arms race takes place. We think earnings were going to grow, albeit maybe a little more slowly against the higher absolute level of rates this year. But earnings look pretty positive, and the S&P performance is broadening. Even though those top stocks drove indexes over the past years, those top 10, the top Magnificent Seven, we think that we'll see some broadening in the small cap and mid cap space as they make up some of that ground and chase those larger cap names as well. So that's pretty positive. On the bond side, again, starting coupon rates are attractive. The tax on savers has been removed, right? So back in the 2008 to 2015, 0% rates, you couldn't make money saving. But now cash is earning about 5%, so really attractive. Bond yields are about 3 times the dividend yield on the S&P, so still relatively attractive to stocks from that perspective. And then the real yield on the 10-year Treasury, the highest since 2009. So real dollars coming in are those are the dollars you spend. So bonds from that perspective are also really attractive. So what are our recommendations? Well, stick with your financial plan, right? Stress test it as needed. We can show you what if returns are lower than expected, what if inflation is higher than expected, and make sure that your plan works based on your individual situation. Maintain a disciplined investment approach. This is the mantra that we have in our investment committee, and as part of our DNA, if you will, is that we are not bullish, we are not bearish, we are process. We follow a disciplined investment process to run our investment approach. We don't just go with our gut and what we sort of think is going to happen this week or this month. We know we can't control the markets, but we can control our actions. You can rely on us for providing that disciplined approach to investment strategy, our investment process, and our holistic financial planning. So thank you, everybody. Thank you for joining us. Appreciate the opportunity to give you some input on what we think is going on in the markets and our outlook for this year.
Yeah, I think my big takeaway from this presentation was that time in the market and not timing the market is important, and that the near-term outlook seems pretty positive.
I think that hit right on the head, Kyle. It's exactly what I'd say.
All right, I'm glad we're on the same page there. And on that note, thank you to everyone for attending and participating in our 2024 market forecast presentation. As a reminder, a recording of this presentation will be made available in the coming days. If you have further questions regarding the topics and information we discussed tonight, please don't hesitate to reach out to your Affiance financial advisor. Have a great evening, everyone.